Warren Buffett just made the biggest investment of his life. He's always avoided tech stocks. He's never invested in Tesla, Nvidia, or Google. But something has changed. The recent F-13 filing shows that Warren Buffett, for the first time ever, invested in Google. And that is very strange and unusual because we are in this hyperinflated market and the entire stock market does not make sense. And that's why Warren Buffett has been accumulating cash for the last 3 years and is almost on $400 billion worth of cash. So what exactly has changed and why Warren Buffett suddenly wanted to invest in Google? Let's figure out. Warren Buffett's investing strategy has always been Benjamin Graham's strategy. You buy troubled businesses at an extremely cheap price and then you restructure and improve them and then sell them for a higher price once these businesses start to generate revenue. Imagine you look in the streets and you find a really bad business. I mean, they have some good products, but the company is going through some kind of a crisis. But it needs some improvements, some investments, and once it's fixed, then it can be sold at a higher price. Imagine there is a very bad piece of real estate in a very good neighborhood. You buy the property, renovate it, fix it, and then you sell it for a higher price. It makes sense. That is the investing strategy that Benjamin Graham laid very clearly in his very famous book, The Intelligent Investor. But after following this strategy for decades, Warren Buffett realized that this is a very bad strategy and you should not be following this strategy. Bad businesses take a lot of time, they take a lot of stress, and very rarely they are turned into great businesses. What is a far better investing strategy is to focus initially on very great businesses at a fair price. If there is a great business, that business is run by very passionate people who know exactly what they're doing. They have products that are always there in demand. Take an example of Apple, which is a great business. You first get yourself an iPhone, then a MacBook, then an iPad, and then suddenly you realize that your entire life consists of Apple products. Great businesses also have brand loyalty. When you see the brand, you're like, oh, I like that. I'm gonna buy that because I trust that brand. The reason that so many people buy Nike shoes is because there is such a strong brand loyalty. If you see that Nike sign, then you know that that's the kind of shoes that you want to wear. Since they have such great products, they are run by very passionate people, these businesses usually thrive, they grow over time. And that's why the strategy is simple. You just buy these businesses and you never sell them unless the fundamentals of the business change. If suddenly the brand loyalty is lost, suddenly the management is bad, suddenly they start producing very bad quality products, and that's when you sell that business. The problem with these companies is that they attract a lot of investors. Suddenly everybody wants to buy in that business, and that's why you see the stock price skyrocket to the roof. It is very difficult to find such businesses at a fair price. Take an example of Palantir. It's a very great business. They have such a strong brand loyalty and they're actually changing the world. But the problem with Palantir is that there is so much demand to Palantir that their stock price is not being backed by earnings. So it's overinflated company. And that's why the trick with this strategy is that you want to buy that business at a fair price, at a price that you know for a fact that is being backed by real earnings behind it. In 2016, Buffett invested in Apple. When Apple already developed the iPhone, it developed its business strategy, and since then, the stock has grown by over 1,000%. Why would you buy a troubled business when you have a great business that has already grown by 1,000 percentage points? And the only reason that he sold a substantial amount of his investments in Apple is not because something has changed with Apple, but rather his Apple investment became so big that it dominated his entire portfolio. In fact, back in 2017, in his annual letter to shareholder, he told the shareholder that he regrets not buying Google and Amazon. These two businesses were extremely great because Warren Buffett holds a lot of small businesses, and all of these small businesses use Google ads to advertise their products. So basically, if your businesses are using Google to sell their products, Well, maybe you should be investing in Google because they have a product that every business on earth wants. But the trick in investing is that you don't buy businesses just because they're great. You buy great businesses at a fair price. And that's what differentiates a great investor from a beginner. Because those old beginner investors who try to tell you that you should buy Tesla, Palantir, or Nvidia, yeah, they're going to give you a very good reasons, but it's already too late. The price of that stock is overinflated. The demand is so strong that the stock price is shot to the roof. And that's why Warren Buffett was waiting until the price of the stock drops to the point where that price is backed by real earnings. And that's when he jumped. And in 2019, he invested in Amazon. And it seems like we've got to the point where it's time to buy Alphabet. It's time to buy Google. The stock market is certainly overvalued, and most tech stocks are being sold way above their real valuation. But if you look at Google's stock price, even though that its valuation is about $3.5 trillion, its PE ratio is about 28. PE ratio basically is how much investors are paying for a single earnings of the company. So the higher the PE ratio, the more investors are paying in hopes that that company is going to generate a lot more money. For tech companies, a PE ratio of 20 to 25 is considered normal. Based on this very simple metric, Alphabet is not insanely overvalued like Palantir that has a PE ratio of 200 or 300. There was a time where Tesla's PE ratio was like 850. Can you imagine that for a moment? And that's why since then the price of Tesla stock has dropped. Some might say that, well, the market cap is like $3.5 trillion. It is clearly overvalued. The market cap could be even $10 trillion. That doesn't matter. We have to check the market cap and see if it's being backed by real earnings. In 2024, the company generated a revenue of $350 billion and a net income of $100 billion. There aren't many companies that can tell you that we have a net income of $100 billion. I don't think even Nvidia, which worth over $5 trillion, I think its valuation has already dropped since then, is not even making $100 billion. And yet Nvidia has a $5 trillion valuation and Google has a much lower valuation. And these are the revenues and net income for the last year. This year, Google is expected to generate $400 billion in revenue and a net profit of $115 billion. The company is making far more than Nvidia, and yet its market cap is far lower than Nvidia. And that's why maybe you should be buying Google and not Nvidia. Nvidia's revenue and profit margin exploded just in recent years because we have this AI rush that is happening and everybody wants GPUs from Nvidia. And since there is such a huge demand that Nvidia can't fulfill, they have risen their prices. But in a year or two, most likely they will have to lower down their prices to stay competitive as more companies are emerging and trying to build chips that can rival Nvidia's chips. But in the case of Google, they have built their business model over the last 25 years and they have very solid sources of income. 56% of their revenue come from the search engine, and Google's search engine completely dominates the world. It doesn't matter where that business is. Most likely you're using Google ads to attract clients to your business. But besides Google's search engine, they also have YouTube ads. Most likely before this video started, you saw a YouTube ad. There might be ads after the end of this video, in the middle of this video, and a good portion of those revenues directly go into the pockets of Google. They have other services such as Google's Cloud, Google's other businesses, Google's network. So it's a great business with really great management, passionate people who want to grow the business, and there is a strong brand loyalty. So it's a great profitable business, and this is without even considering AI. There is a lot of hype about how much AI could generate in the future. OpenAI have signed already deals worth over $1 trillion, even though that they don't have that money. And OpenAI plans to go public at $1 trillion valuation, even though that the company is generating anything between $13 to $18 billion. Imagine you're making like $18 billion. This is going to be the revenue for this year, and you have a valuation of $1 trillion. And your best competitor, which is Google, they have the infrastructure, they have the talent, they have the money. And the company is already making more than $400 billion in revenue and $114 billion in net income. They have all the money in the world to crush you. If we give Google the same valuation as we are giving ChatGPT, then Google should be priced in the market at more than $10 trillion. But we're not doing that. Yes, ChatGPT is far better than Google, but Google is not lacking behind. They're building the technology and they're playing the long game. OpenAI is expected to generate $100 billion in revenue by 2029. Now, they revisited their projections and forecasts and said, we are going to make $125 billion, and those additional incomes are going to come from new products that we're going to develop. What are these new products are going to be? Nobody knows. Maybe they will integrate ads into OpenAI, into the ChatGPT. Will it continue to grow at that rate? If we have these projections for OpenAI and we're already valuing the company at $1 trillion, even though that they're generating $13 billion, and a huge portion of this market cap is going to go into Google, just imagine how much Google is going to multiply its revenue over the next few years. But even if that does not happen, Google still justifies its valuation today with its current business model. And if they take advantage out of AI and beat ChatGPT and OpenAI, that number could double or triple. That is most likely why Berkshire Hathaway decided to throw $5 billion into Google. A really great business sold at a fair price at the brink of a huge opportunity to take over AI. Thanks for watching, and I will see you in the next one.